Today we're going to talk about the financial concept of stock buybacks, also called share repurchases, and start out with this slogan here that I think everyone ought to tell their kids, which is always make someone work as hard to take your money as you did to earn it. And of course, you'll see people that didn't have to work for their money dispense it more freely. And there's nothing wrong with that. There's nothing wrong with people who didn't work hard for their money. That's just how life is. And we don't sit and complain about that and talk about how privileged they are. We just work harder. So when you're investing your money, you're looking for a return on your capital. And you need to pay very close attention to your investments because there are a lot of trendy concepts that don't benefit shareholders. For example, ESG investing, the black box that we've recently covered in a video. I'll put a link to that in the description of this video, along with the divisiveness of DEI policies. And of course, Web 3.0, you'll hear some of the thought leaders talk about how investing for them is a form of activism. Well, it's actually not. And we wouldn't invest a penny with anybody that thought that way because we invest to show a return on our hard-earned money. So there are three ways that happens when you invest in equities. There's the most commonly thought of method of returning capital, which is share price appreciation. Most people think about, let's say most retail investors think about share price. I'm going to purchase at this price and I'm going to sell at a higher price. But there's also two other ways that capital gets returned. Dividends, that's fairly intuitive, and share buybacks. This isn't so obvious, the impacts or the methods, and that's what we're going to talk about today. So when we look at buybacks, that's a form of concentration. And we wanted to start out talking about dilution, which is when companies start issuing shares to survive. And you'll see this with pre-revenue companies and firms that sell a great story and nothing else. And a personal pan pizza doesn't feed 20 people if you cut it into 20 slices. That's the idea behind dilution having a negative effect on shareholders. And here we've taken the example of Selecta Biosciences. This is a real world example. In 2015, that's the number of shares outstanding they had. And if you had purchased a share for $1 then, by the middle of this year, that dollar would be worth 7 cents a share, all things being equal. That's how dilution works, and it goes unnoticed by most retail investors. So let's start by talking about market cap and how that works. Market cap, for all practical purposes, is simply the total value of a publicly traded company. It's easy to calculate. You simply take shares outstanding and multiply that by the price of shares. So intuitively, when the price of shares changes, so does the market cap. And we've used Little Johnny's lemonade stand as an example. If you have 1,000 shares at $1 a share, that's $1,000 market cap. And if the price of those shares changes to 80 cents, the market cap moves to $800. And if it goes up, then the market cap increases. You can see the example here. So as the stock price changes, so does the value of a company. Now, going forward, let's just assume that this company has an intrinsic and actual value of $1,000. That means it's priced at $1 a share, and that's what it's actually worth. Now, Little Johnny wants to raise some capital, so he takes some venture capital investment. He issues shares. He doesn't sell shares that he owns, he issues shares. 250 shares to VC1, 250 shares to VC2. So he's diluting the company. Now, remember, the value of the company has not changed. It's still $1,000, but the price of shares has to. And you can see in the example here that each VC holds 250 shares that are priced at 66 cents per share. That's the value that they hold. Johnny's value of his shares has fallen, of course, because he's being diluted. So his value has fallen from $1,000 when he owned all the shares in the company to $666 because he's sold a chunk of the company to raise capital. Now, let's say that Little Johnny wants to buy back shares and he's going to buy out VC1 and retire those shares. So when a company buys back shares, they can either retire them. Well, they retire them, of course, but they can do two things there. They can put those shares in the treasury, which means that they could sell them again, or they can cancel them. And if they cancel them, then it becomes more difficult to issue shares in the future because they have to get approval from their shareholders. So here we see the before and after. Look, the value hasn't changed. What has changed? Well, VC2s, their value has gone up from $167 to $200, and Johnny's has as well. That's how share buybacks increase the value of shares. It's very simple. They simply concentrate the shares that are being held by existing shareholders, and it's simply the opposite of dilution. Now, when we look at how a company uses profits, and we think about company-focused uses of cash. So when a company starts to generate profits, they do something with those profits, and they can either repay debt, they can acquire other firms, they can invest in future growth internally, or they can give money back to shareholders in the form of dividends or stock buybacks. And when we look at the size of a company and the growth or value profile, you can see that as a company is small, they're having to raise a lot of capital to capture market share. And then when they become a leader, as NVIDIA has, then they start to mature. And then that's when they'll start thinking about providing capital back to shareholders in the form of share repurchases, share buybacks. You can see here how NVIDIA has decided to purchase their shares, and that's because they have a lot of free cash flow. You can see that on the left-hand side here. And they've also started paying a dividend. And of course, there are also strategic investments. So as a company matures, they'll start to give capital back to shareholders. And you'll actually see with European firms that growth firms in Europe will start to do this quite early. TeamViewer is one example of that. So share buybacks in the United States, those were illegal before 1982 because they were said to be manipulative. And the benefit of a buyback is that they're far more tax efficient for companies since dividends are taxed twice. So once as corporate income and again as dividends. So just this year, a law was passed, a 1% tax to pay for clean energy and lower drug prices in the United States that will tax share buybacks. Reuters says that will have a trifling impact on corporate behavior because it's quite small, and that will generate about $74 billion over a decade. So overall, an easy way there to get some tax money without impacting corporate behavior. We'll see, of course. And here's a chart that shows the money that's been paid back to shareholders over time, rolling, 4-quarter rolling there. And you can see the dark blue line is buybacks and the light blue line is dividends. You can see the consistency of dividends over time. Now, we need to be very careful about legislating laws that govern how companies work. This is a leading lawmaker that most individuals in the United States would know very well, who says he hates stock buybacks. And this sentence here, instead of investing in workers and in training and research and equipment, they artificially raised the stock price by reducing the number of shares. And he says, oh, they're despicable. Well, that's not true, because companies should only invest in projects where there is a positive net present value. And MBAs spend a great deal of time and money learning how to calculate things like that. So the government needs to be careful about how much they dictate what companies do. And there's a article by INSEAD, it's called Biden's Misguided Tax on Share Buybacks, that provides some comments around this. It's something to pay attention to. Now, here's a piece that was put out by McKinsey. It's really good. It's called How Share Repurchases Boost Earnings Without Improving Returns. And McKinsey claims that share buybacks are a wash. And in this diagram, you can see how they've demonstrated that the value of a company doesn't change. But one thing does change that's very relevant to dividend growth investors, and that's the earnings per share increase that happens when you reduce the number of shares. That's intuitive. That makes sense, that if you're dividing your profits amongst shareholders, if there are few shareholders, that everybody gets a little bit more. So this artificially increases earnings per share. That's very important. And what you see are companies like IBM, Big Blue, doing buybacks for decades. You can see that on the chart here. And what this reduction does is it significantly boosts earnings per share growth rates, even for companies with mediocre top line and bottom line growth, IBM. So you need to be very careful about that. So just to conclude, both buybacks and dilution fly under the radar of many retail investors. And when we look at share buybacks, there's an element of market timing there. So companies ought to invest in share buybacks in bear markets when their shares are cheapest and when there are no suitable internal investment opportunities. And companies that conduct buybacks for long periods of time may be struggling to find growth. So please put your comments in the comment section. Make sure to subscribe to our channel. Thanks for taking the time to watch this today.